Hey everybody, how's it going? Welcome to another video. In today's video, I'm going to talk about two option strategies on different stocks that you could utilize. And keep in mind that these stocks are under $10 a share. So these are very small account friendly. And these strategies you can definitely utilize if you have only a couple $1,000s in your account. These strategies do not require upwards of $10,000, $20,000. So hope you're excited. Quick reminder, if you could like and subscribe and comment down below any stocks you want me to cover. That really helps out the channel. I'm really looking forward to any other stocks you'd want me to cover. So jumping in, the first stock I'm going to cover is obviously Palantir Technologies. So it's currently trading for $8.25. In the past year, down 35%. So pretty significant, but you could see over the past couple of months, somewhat of an uptrend. So now looking down, so earnings are coming up. So you're definitely going to want to be careful. And when you're choosing the option, and we'll walk through this, make sure you're looking at an expiration date that's not near earnings. So quick highlights: market cap $17 billion. Palantir's engages in development of data integration and software solutions. 52-week high 1486 and 52-week low of 584. So just wanted to quickly highlight those few things. Now jumping into the options. So I'm going to quickly show you how to do this in Robinhood. So in Robinhood, you'll click Trade Palantir Options, and then it's going to take you to this screen. So for the strategy I'm going to cover today, you're going to be selling a put and buying a put. So effectively, the strategy is called a put credit spread. So it's a bullish strategy where you want time decay to be at your advantage. You want the stock to remain neutral or move upwards. So the example I'm going to walk through today is the put credit spread. So what you do in Robinhood here is you can see the current share price is $8.25. The first thing you're going to do, which I've covered in other videos, is go to the expiration date. When selling option strategies and doing option strategies, if time decay is to your advantage, you typically want to do about 30 to 45 days out for selling calls, selling puts, put credit spreads, call credit spreads, etc. So I'm going to select March 17th for this example, and I'm on a put and I'm selling a put, so that's perfect. So how are you going to execute this put credit spread? So this option strategy is going to consist of two options. For one option, you have to remember it consists of 100 shares of the stock. So since the stock is trading for $8, in theory, one option is worth $800. But you'll see that that's not necessarily the case of the amount of income that you'll generate by executing this strategy. So for the put credit spread, there's going to be two options. You're going to have to sell a put and buy a put. The first leg of this strategy, remember this is just an example, but you would be selling a put, so a strike price below the current price. And over here, you can see the max loss is currently $741, when you'll see in a second, it won't be that much and it'll actually be significantly less. So if you were just to sell a put and you had, $800 of collateral, you could do this strategy, this trade, and collect $59 today, which is great. But what I'm going to do is, for the put credit spread, is actually protect yourself. So I'm going to buy a put, and then I'm going to buy one leg lower. So now I'm buying this put for 26 cents for one contract. So in reality, $26. And the delta of these two options is going to be 33 cents per share. So one contract has 100 shares, $33. And I'm effectively risking the spread between 8 and 7, these two strike prices. So that's $1. So I'm collecting $33, but I'm only putting up as collateral $100. So that's almost a 33% return in a 1 month time frame. Yeah, that's definitely not always realistic, but you have to also measure your risk and reward profile. So I chose strike prices very close to the current share price. If I were to do this strategy much lower, at a lower stock price, you'll see it's not going to be as high of a premium that you'll collect. So if I were to sell a put, for example, at 7 and buy a put at 6, I'll collect $14 total for one contract here. So in this strategy, I would collect $14 for putting up $100 of collateral. So that's a 14% return, which in 1 month is not bad whatsoever. But you also just have to determine what is your risk to reward perspective and positions. That's the quick example on Palantir, and this is definitely a great strategy if you have a smaller account. This will allow you to get quick wins, get some small trades in the books, collect weekly, monthly income to slowly build up your portfolio. And if you have a couple $100s in your account, you could do a couple of these options. Now, the second stock I'm going to cover is Sofi Technology. So this is another small account friendly stock, definitely a different industry in a sense. They provide financial services, offer loans, personal loans, school loans, and a credit card. Similar size company, 2,500 employees, but market cap significantly smaller at the moment. So about $6.5 billion in market cap with a 52-week low of $4.24. 52-week high of $13.41. This is the second stock I want to cover. As you can see, 1-year chart also down, but same time frame. Past couple of months, it's been shooting upwards. So I'm going to walk through the put credit spread strategy that you can utilize on SoFi, which is also trading below $20, $7 stock. So one contract will require 100 shares, which is only $700. So yeah, I think this is a great one as an example to use. So for the put credit spread, I typically would do 30 to 45 days out. 37 days is perfect for March 17th. I want to be on a put and I want to be selling a put. And now looking at the strike price, it's currently trading at $7.17. So taking that into consideration, you can see here the premiums are not that much since the stock is so cheap. So for this type of stock, it may only make sense to kind of sell the leg right below the strike price. So for this example, I'm going to select the $7 strike price. So if I was selling a put by itself, if I had $700, I could sell this put for $7, collect $44 today, and I'd be putting up $700 of collateral. So if I was selling a put, which is another strategy, I'm effectively saying I'm willing to purchase a stock at 7 if it goes below 7. If it stays above 7, I keep this $45, option expires worthless, and nothing happens. So that's a win-win. But for today's strategy, I'm going to focus on the put credit spread. So I'm not exposing my risk to $700. So what I'm going to do, I'm going to buy a put at a leg lower. So I'm going to buy the $6 put here. So in this example, the spread between these two strike prices is $1. So the amount of collateral is $100. The total credit you'll earn today, if you execute this trade, is $30. So in theory, it's a 30% return and a max loss of $69. So 30% return in 1 month, pretty crazy. But again, you have to consider what's your risk and reward profile look like. But keep in mind, this put credit spread, call credit spread, these strategies where you're selling a put and buying a put, you can do this on larger stocks like Apple, even if you have a smaller account, because the spread typically between the two strike prices is going to be something like $5, which would be $500. So I definitely have other videos on that. Take a look at other videos I've done on put credit spreads on Apple, Google, etc. Otherwise, I'll definitely do some more in the future. Hope you enjoyed the video. Quick reminder, if you could like and subscribe, that'd be massive to help the channel grow. If you have any stocks or strategies you want me to cover, feel free to comment down below. Hope you have a great one, and I'll talk to you soon.